All right, awesome. So one of the first things I think we really need to break down is how options are priced, because you can understand the price and the price breakdown and the price movement of an asset, then you can make money when the price goes up. Now, it's a little bit easier with stocks. With stocks, if the price goes up, you make money. If the price goes down, you make money. With options, it's a little bit different. One of the biggest things that matters with options is this idea that they have an expiration date. So if you buy an option and maybe you want to buy a call at this price level right here for whatever stock this is, the price of the call is obviously going to depend on the current price of the stock, but it's also going to depend on the expiration date, right? So if you want to buy it and you're right here and you want to buy it right here, if it expires in a week, it's going to be worth a whole lot less than if it expires in 4 years, right? And so the longer time period you have, the more the option is going to be worth, because it has more time to get to this price level right here, and therefore it has more time to break even, which means you have more time to create a profit, to go into the green, right? So if you think that the stock is going to absolutely crush it over the next 3 or 4 years, a lot of times you'll see options where maybe it's a $10 stock and the option will be like $5 for the next 4 or 5 years. So you're paying about half the price of the stock to get a chance of the upside when it gets to this price level. But at the same time, you're risking all of your initial investment if it doesn't get to the price level. So what I really want you guys to understand when you go through this module is that options are basically not for long-term investments. If you're going to hold anything more than a year, maybe like two tops on a small volatility stock, I mean, anything past a year, I've personally never traded an option for, just because it doesn't really make sense. You don't know, a lot of times with these swing trades, they're a little bit less predictable than 9 to noon trades, especially once you start to get past that 6 month, 8 month golden time horizon. That's really what I found to work the best, is about 6 to 8 months for a longer term options trade. Now, I'm not saying it has to be 6 to 8 months. Really, really great trades are possible in a time frame of 1 month. Really, really great trades are possible in a time frame of 1 week. What I really like to use options for, and this is something that might depend on where you're at and how much time you had to invest, but I like to use options for swing trading and magnifying my returns, specifically with about 4 to 7, 8 month trades. Because usually those trades, maybe if it's going to go up 30%, it would yield me 30%. But with options, I can kind of leverage that up, right? So I'll make, triple figure percent gains, make hundreds of percent points without necessarily having to have a massive movement in the underlying stock. Because a lot of times, especially if you start to trade pricier stocks, the actual movement of the company is a little bit slower. And this has to do a lot with floats, and we'll get to floats a lot more very soon. But the point with it is that as you look at a longer time horizon, it's more expensive to actually buy it. And the more expensive the stock, obviously, the more expensive the option. So that's another important factor. Volatility, obviously, guys, if this company, instead of having a chart like this where it's nice and stable, we just kind of race that away and we look, maybe we say this is like an absolutely crazy stock. So if you look at a company, maybe like A&G, right? They're going up and up and up, bam, and then they go down and down and down, and then they go up and up and up. This is a very volatile setup, a very volatile pattern. So options prices are accordingly going to increase because the volatility is higher. And the premium is what you're really going to pay for the option and the total control of the option. The premium is made up of inherent value, time value, and obviously volatility, expected volatility, implied volatility. And this implied volatility is a really, really important measurement, volatility, that we're going to look at more throughout this course. But this is a really, really important concept that we're going to break down a ton more when we look really at some of those overarching volatility indexes like the VIX. So we'll get to that pretty soon, but that's an important part. Essentially, what you're looking at is if the strike price is at 20 bucks and your call and the current price is at, say, 20 bucks as well, they're the same. Okay, the inherent value is $0, but time value might be very large. If it's maybe a 1 year option, 1 year call per se, it's going to be worth a lot more than maybe just a 1 week call or a 2 month call. So if you have a whole year to actually exercise it, a whole year for this to keep going up, a whole year for this price to change, all of a sudden that becomes worth it. So this has some inherent value in the time value. And then the other thing is expected volatility, right? So if you look at this chart, this is pretty freaking volatile. So if AMD, if it chilled out and it just kind of went sideways and it never really moved anywhere and it was very, very, very stable, obviously you can see this expected volatility value be pretty low. But if we look at how it's performed recently, historically, just as an example, a very high volatility, thing freaking tripled in like a year, it's going to have an increased expected implied volatility. So you're going to see this right here start to increase in price. So these can get pretty pricey, but the point with them is that this premium is significantly less than the actual cost of ownership of the stock. So for example, the AMD, instead of paying $30 a share, might pay $2.50, $3 to control a lot of shares. So very cool concept right there. And specifically with stock options, very important point here when we talk about leverage and we talk about value and we talk about pricing, we talk about the actual cost of owning an option. If you want to buy an option for a stock, you're going to have to buy an option times 100 shares, right? So when I say it costs $3, it's going to be $3 times 100 shares. So you would have the ability to control 100 shares for $300. And then if the shares go up, from $20 to $26, something conservative, I mean, they've done that a whole lot, then you're going to make $6 per share. $6 times 100 shares equals $600. So at a very fundamental, rudimentary level, you really want to look at your potential upside in dollars and then compare those dollars, that upside profit, with the actual cost of the option in dollars. And we'll look a whole lot more about actually figuring out what this number is when we look at technical analysis and the indicators and setups you can use to accurately predict this and set up solid risk-reward ratios so that you have excess profits with minimal downside and you win more and more trades, or at least make more money, because that's what it all boils down to, is minimizing downside and maximizing the upside. So really cool concept, and it all stems from this idea that the premium is what you're going to pay when you go to buy an option, and that premium is affected by inherent value, time value, and implied volatility. Now, what's really cool is that in 9 to noon, I actually shared with you the freaking coolest chart on this planet. I'm going to redraw it now because it's super important in understanding this volatility and time value of an option, which is the most important part that you're not going to tell just by looking at the inherent value, right? The inherent value, I mean, it's pretty basic. If your strike price is at $23 and the stock is at $20 and it's a put, so it lets you sell, if you can sell $23, inherent value is $3. Very basic concept. Same thing with a call, okay? The price is at $20 and the call is at $17, it has an inherent value of $3. But this time value and this implied volatility is a powerful concept, and it all really comes from this idea of options value versus time. Now, this is a concept that you have to understand specifically when you're looking at like 1-year trades, 6-month trades, 8-month trades, and you'll see it a lot if you have very short term, like 1-week trades, because the cost of the option will change dramatically. It's a lot cheaper to buy a 1-month call than it is to buy a 1-year call. Very basic concept, but for a stock that's $30 like AMD, or whenever you're watching this, it might be freaking $100. Who knows? I don't think it'll be $100 just yet, but we'll see. It might cost $3 to buy a yearly option, but it only costs 30 cents to buy maybe the next 2 weeks for an option. And we'll talk a little bit more about the option time frame soon, and we talk about it more in 9 to noon, but it's a very basic concept, not too difficult. We'll get to it in just a moment. But what I want to look at first is option value over time. It starts out really high, right? So if you have a lot of time, you're going to have a lot more value than when you have a very little amount of time. So if we look at like days till expiration, this would be 0 days till expiration. This, and here it's 100 days, but you can just make this really any number you want. The more days, the bigger the value is going to be. Very simple concept, but very powerful concept. So it starts out really high, and then it goes down and down, and then it kind of gradually just paints into 0. And that's kind of the importance of understanding your position, understanding really where you're coming from with these options, because the goal with this is to play off volatility. And the best way to play off volatility is by playing off technical setups and indicators, and that's everything we're going to talk about very, very soon. But you want to make sure that you have setups that are going to move quickly, because this time value decreases fairly rapidly, especially when you get to start to this, this last quadrant over here. It starts to go down pretty quickly. So you want to make sure that the setups you're trading, they go through quickly, they execute fast, so that you do make this $600 profit, or adding the zero to it, 6 grand, 60 grand, 100 grand, 6 million. The really cool thing about asset markets, financial markets, you put another zero on there, 60 million, 600 million, 6 billion. You can add as many zeros as you want, especially with options, because this stuff is infinitely scalable, infinitely up and up and up and up. You take it as far as you desire. It'll just keep going. That's what's cool about this. Take your profits, instantly reinvest them. Up your position size, as long as you have the fundamental skills at the basis of your investments, you can scale this to make as much money as you desire. A very powerful concept, and it's something I'll talk about so much more in the Think and Grow Rich course, about like setting your goals and your passions and your desires and your dreams. And I'm sure a lot of you guys have gotten your hands on that. If not, it is special offer for new clients only. So we'll see if it might be in the membership area. Totally up to you. But that stuff changed my life. So awesome. And it'll help you with this, because you want to keep increasing your trade size. You want to keep increasing what you're doing, the value that you're bringing. And the best way to do that is up that position size over time by reinvesting profits, so you can continue to compound and compound and compound. And obviously, we'll talk a little bit more about that as we discuss compounding in some of these classes and master classes. So a lot of really cool stuff there that all stem from this underlying principle of options premiums, right? So you want to make sure you understand at a very basic level the cost to get in is based on inherent value and time value implicit volatility. So if you're looking at the price, and there's a discrepancy between the actual value and the price of the option, which is something you're going to see once you start to trade, once you start to buy. Remember what it's based off of and use it to your advantage. You want to trade the stocks, the assets, the derivatives, the currencies, whatever you're trading. You want to trade the assets that don't really have a great options premium pricing. So for example, if you look at a trade and say it's a head and shoulder setup, right? So you have a really, really, really nice head and shoulder setup, okay? And like there's a pretty freaking good chance, and we'll talk about this setup in a second, but I just want you guys to understand the principle here. You know that there's a really nice chance that this thing's going to go down. But the call options are like, say this is a $50 stock, okay? The call options are $5. And the put options are like $1. And so you'll find these examples in the marketplace where, and this would be like the same price. These are both strike price $50, right? And you can have way more profits by trading the right way. So this is an example, right, where you would see that, wow, the expected time volatility is very, very, very low for the way that you think it's going to go, right? So for this example, you think head and shoulders usually means it's going to go down, right? So you want to look for examples and trades and setups where it has an asymmetric risk-reward ratio, and you're making a lot by risking a little. Minimum setup for a lot of these options trades, especially the ones I do, I really try to look for about a 3 to 5 risk-reward ratio. I don't want to be risking more than $1 to make about $3 to $5 back, and that's a setup and an indicator and just so much more that we'll get into soon. And the best way to get to that point is to use the power of technical analysis, setups just like this, indicators that go alongside this, so that you can find these trades where it's much cheaper to get in and then make a ton of money. So if this thing goes down to $40, I mean, I made a trade very, 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 very similar to this with Wells Fargo. Wells Fargo, they were at like $65, and they were in head and shoulders just like this. I shorted them down to $45. I mean, that's $15 a share. So if you put $1 in an option, and I would usually short maybe this shoulder here, so I think I shorted it like, sounds about right, making $15 for every dollar that you risk. That's a very, 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 very great setup right there. You take that trade 10 times a day, absolutely crush it. So that's what I want to help you identify here. That's the point of this course. That's the point of these modules, is especially when you're starting out, you don't have as much capital to go with. You want to be careful, and you want to understand what you're doing, and you want to learn. But this is a really good way to grow cash quickly once you know what you're doing. You gotta know what you're doing. I highly, highly recommend that you at least take a couple of days to trade 9 to noon before you go into some of these riskier investments. Because, like I said, you put $100 in here, whatever you're trading with can lose it all if it doesn't go your way. If this thing goes back up and it expires worthless in 3 months, then you're going to be out of the money. So it's a very, very delicate investment vehicle, and it's awesome that you're here learning this stuff because it means that you can take advantage of it and have the best possible chance of succeeding and go out there and absolutely crush it so that you're doing the right steps to get the right results to make a profit in the marketplace. Very, very powerful concept, and you're doing the best thing you can do by being here, by learning this. That's really going to be your path to take the quickest possible path to have profits in these markets and to absolutely crush it. So hope you guys got a ton of value from this module. Go out there, crush it. Make sure that you understand premiums. Very, very simple. Log into your broker. If you guys haven't seen, some of my top brokers, just 9tonoonsecrets.com/brokers, and it'll tell you sort of up-to-date, current, what my recommended brokers are. Look and see where you can trade. So just pick some of your favorite stocks, any stocks that you have in your portfolio, and see if you can trade options. You can't trade options on all stocks, but if you can trade options, they're regulated by options exchanges, stuff like that. You want to make sure you can't trade them all, but see if you can trade options on one of your favorite stocks, and then go out there and look at the premium prices, especially over time. Like, pause this video or finish this module, and then go into Yahoo Finance. You open up any stock on Yahoo Finance. All you have to do is a little tab at the top, and there's a button that says options, all right? Click options, and that's going to show you all the options. It's going to show you the full options chain, so you can actually see these premium prices in real time, and you can understand, hey, if I bought this, a month ago at $1, and now it's at $3, I would have doubled my money. Why is that? How did the actual underlying stock move? Remember, all of this is based on underlying price movements in the stock, underlying setups in the stock, underlying indicators in this stock. And that's why when we look at using the insane power, these two words that just changed my life. Look at technical analysis. Technical analysis is going to be your gateway into really, really, really crushing it with options, because everything's based on stock price, and you can predict stock price extraordinarily well using the power of technical analysis. These techniques, these strategies, these two words absolutely changed my life, and I just cannot wait to get you learning more about this and into part 2 of 9 to noon and in some of the extra little trainings we do here, because this stuff is profit. This is money. I mean, this is learning how to print money from the most powerful economic machine in the world, and that is the American equities market. Very cool stuff here, guys. And remember, this is going to be applicable across all asset classes. I've seen these setups in crypto. I've seen them everywhere. You got to remember, though, when you look at stuff like currency, stuff like forex, stuff like crypto, a lot of these aren't as regulated as U.S. stocks. So these options, right, they go through centralized options exchanges, at least as of recording this video, right? So you just got to go under Yahoo Finance and click this little options tab and see if the stock that you're interested in actually has options. And most 9 to noon trades, they don't actually have options. Very, very small part of them. Some of them might have options. So just look around and understand that not all stocks are going to have options. So you want to make sure that you actually find the ones that do, and then trade them very, 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 very well. And that's going to help you absolutely crush it and multiply those returns once you understand how to create the returns in the first place. You got to get that fundamental basis down, and that's the exact purpose of all these trainings, is so that you can have that success. Because it all stems, option value. It doesn't matter if time value goes from $1 to $0. If you can't make a trade, it's going to make you $2, $3, $4, $5, $6, $7 on every dollar that you bet, based on the inherent value. That's really the game here. The game here isn't really to try to time the timing or game the timing. The game here is to have fundamental growth and actually predict the price of the underlying stock and profit by taking this profit right here. And you would originally have to put up $45 or $50 to actually short this stock, or if you were going to go long, you'd have to put up $50 to actually buy this stock. And instead, since you have a compressed time frame, and specifically using technical analysis, you can actually know very, very carefully how long the trade's going to last. And we'll look at this concept more and more and more as we get into some of these setups. But once you understand how long a trade's going to be, you look at an option, maybe you add 10, 20%. So if I think it's going to take 3 months, I might have a 4-month, 5-month, 6-month option just to be safe, cover my butt. Because it's not a huge difference, right? It might be a 20% difference between a 4-month option and a 6-month option pricing wise. But for me, an extra 2 months, that gives me a lot of extra time to play with. And with flowers, it took me about a month to make a ton of money and sell that option. But that was a 6-month option because I knew that they could crush it for a month or two, and I wanted to have my safety. And the difference in pricing was like a couple $100, but it was well worth it because it gave me that flexibility, and you have the same profit either way. It just affects your risk-reward ratio because you're putting out more capital in the trade. But relative to the actual price of the stock, right, like $50 stock, you put down $5 to have control of it. I mean, $5, $7. Those are both very nominal amounts to control this stock if you know that you can make, $7 on the downside or $15 on the upside, whatever it is you want to be looking. If I'm putting down $5, I would like to make at least $10, $15 so I have a 2, 3, 4, 5 risk reward ratio. Because remember, you are risking pretty much everything you put down. So you want to make sure that upside potential is there so that you have the biggest trades possible. Because remember, the basis of a lot of investing is don't lose money. And with options, you're really on a fine line of losing money. And something that will happen a little bit more often with these positions just because they do expire. And I've had a lot of trades, especially with these shorter time frames. If you look at like 1 week, 1 day, 2-day options, these are sort of the assets that can go to zero. They can go to nothing. They can go crash and just zip. I mean, I've had options where I was trading GE pre-earnings, and GE is just an amazing stock. I bought them at like $7, they went to like 11, $12. I mean, they've just been crushing fundamentally. They've been awesome. I have them just as a normal stock. I started to trade options on their earning dates, expecting them to have sort of that big bang, that big boom, that big shift. And I'll show it to you real quick just so that you understand kind of where I'm coming from. But the basis of it is like you can lose it all with options. So as you go into these next modules, I want you to focus on taking what I'm saying and then thinking like, well, how can I apply this to make guaranteed profits? Because the instant you can make guaranteed profits, you're above 99% of investors, because most investors are just looking at a chart and they say, oh, it's going down, oh, it's going up, oh, I should probably, buy here, oh my God, my emotions are taking control of me and I want to sell here. Most people, they're buying low, or they're buying high and they're selling low. And that is not the strategy you want to be employing. That is the quickest way to go bankrupt right there. Because emotion, and we're going to talk about this so much in the emotional mastery section or the module somewhere around this training area, because that's a very important concept. But the really cool thing, and specifically with GE, and then we'll move on to the next module, they've been just crushing. I mean, really great gains. And so I see this and I say, wow, well, I'm going to buy a 2-day option for the earnings report. And I would see, here's the important thing. You want to remember that you make 10 trades, 6 of them crush it, 4 of them suck, you're in a good place. You can have great returns with only 2 of those trades, but if those 2 trades make 400% and they cover the cost of all the other 8 trades, then you can still make a ton of money. This is something we talked about in 9 to noon a little bit later in the book. This idea of the profit trifecta, right? And understanding at a fundamental level what needs to happen for you to have portfolio growth consistently and well over and over. And this is, a powerful concept, and it's something that every single setup in this masterclass focuses on, is this idea of consistency, win rate, your average profit loss. And as soon as you can increase this profit 10 times more than your loss, you're going to absolutely crush it. I know it's a little bit out of the frame here, but the important part to note is that if you're making 10 times more than you're risking every single time, you're going to crush it. You're going to go out there and hit it out of the ballpark the more trades that you make. And so the basis of actually accomplishing this is technical analysis, and that's the foundation. That's the baseline of what I'm teaching, and that complements the fundamentals. Specifically with this trade in GE, this was a very heavily influenced fundamentals trade. Okay, everything here was based off of this idea that the company had just hit a massive bottom, and they dropped from like 30 friggin' bucks to this huge low, and then they're going through this corporate refinancing and restructuring and just a whole lot of growth and change in the way that they operate. And so that was really what got me to get in here, is I was like, And if you actually looked at it, it was actually really, really cool. I'll show you it on over here just so that there's a little bit more space. This stock went up a whole bunch in like the 2000s, then it went down a lot, then it went up a whole bunch in '08, then it went down a lot, then it went up a whole bunch, and then it went down a lot. Now, what's interesting is if you look at this position, you start to see the same thing happen over and over and over and over again. It goes down to this price level right here. Now, let me tell you guys something. We're going to look at support resistance in just a moment, and we've taught it before. I want to apply it to options here. But if you see it bottom here, and it's bottoming here again, what do you think is going to happen? Let me tell you what happened. It went from $7 to 12 bucks, 11 bucks. Like, I think it was 11.50, 12 bucks. It just absolutely crushed it. Now it's at like, what, 9, 10 bucks? I mean, it just depends on when you're watching this video, right? But it's a cyclical economy. It's a cyclical stock. This is an energy stock, right? So very, very, very basic cyclical setup. And that's what I was trading here. And so my expectation was, since these guys were in a reversal, right? They're going up and up and up and up and up in a reversal. This earnings report right here would actually help them go up a lot. So they dropped to like 10 bucks. So it would help them go back up, make a new high, and absolutely crush it. So what I did was I bought a call at 10 bucks. That expired in 2 days, and they report earnings. The earnings were, whatever. But it was kind of a flop, And so the stock goes up like 5% initially, and I'm up a whole bunch. And I'm trying to get my butt out of there and sell because it was a short-term position. And so just it flops down after that. It just goes down, trebles down, and it kind of stays flat. And that's the thing with options. If it stays flat, you lose money. Because remember, this options premium, you're paying this price. So for me, the option premium was like 50 cents. So I had to get it to like 10.80 to break even. And it didn't get to 10.80. It stayed at like 10. It went to 10.80 initially, but then just kind of bounced back down to 10.50, 10.20, trailed off. And then after 2 days, it expired worthless. So in day one, I saw the value of the option decrease by 45%. And in day two, it went to 0. So when you're trading your positions, make sure you know that this stuff can burn your cash and it can multiply it at the same time. We were right at the end of this value curve, right? And so it was losing value very quickly since the time value was really the only value to it. Because inherent value is 0 if you don't reach that break-even point of the options premium versus the strike price by the time you get to the end of the trade. And this is a very basic concept that you're going to see a lot more once you start to actually make your first trades. You're going to learn a whole lot about the fundamentals of trading. I mean, all you really have to do is make that first investment and just make it like a $10, $30, I don't know, freaking cheapest you can probably get. I've seen options. You can get like a lot of 100 shares for like 10 bucks. So just make that first trade and start to understand how this actually works out. The best way to do it is to just do it, okay? So with that said, trails off, doodles away. That's the point, right? Is that you're not always going to win with options. And if you lose, you got to be prepared to lose. There was another position in Texas Instruments. Texas Instruments, they reported earnings on a very, very, very close date to GE. And when they reported earnings, a little different situation came out. See, I was not particularly aware of the earnings dates. I will tell you what, I was slacking. That's what was happening. I was just a real big slacker during this earnings season. And so what happened was I didn't really know that like Texas Instruments was reporting earnings, which is freaking stupid because Texas Instruments, for those of you guys who don't know, I would highly recommend you read their annual report. But basically, all Texas Instruments does for about 99% of their business, or at least 80%, like a vast majority of their business, is wholesale semiconductor manufacturing. So they make like semiconductor chips for companies, and then they sell them and they produce consumer electronics. Other companies produce consumer electronics. Most of their business is not what most people know them for, which is the Texas Instruments calculators. Calculators are a very, 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 they're like 2.5% of their company, of their revenue. It's a very, very small percentage. But most people, they think of TI and they think of the calculator. So as you look at them over time, they usually do really, really well in Q3 because what happens in Q3? School starts, right? So over time, Q3, and then this was this Q3, they do really, really, really well. At least historically in the past couple of years, past 10 years, obviously do your own research and look at this stuff. But Q3 does well because public perception, people think that everyone's buying calculators. And even though that's not necessarily true, what moves a stock is buying and selling in public perception and supply and demand. So if more and more people think that they're selling a bunch of calculators and they think that the stock price can go up. Well, what do you think happens? Let me tell you what happens. Last earnings report, they go up 25, 30, 40%. They go up 40% in one day. I mean, that's big. That's huge. That's massive. Now, I want you guys to understand this from a long-term perspective and from an options trading perspective, because I'm in TXN long-term, right? And I'm like, sick, dude, that's awesome. But get this, okay? And this is the power of those very short-term options, because like we talked about earlier, the options value is very, very, very low once you start to get to that last little bit of the contract, right? So that last week, that last couple of days, that's when you're going to have very, very cheap options. With Texas Instruments, they had an options contract that expired one day after they reported earnings. And oh my God, I can't believe I didn't buy it. I feel like an idiot, but the options contract was like 7 cents. And NVIDIA is a $100 stock at the time. Now, even if it was like $1, you're putting down, what, 1 times 100 is $100. And the stock goes up 20 bucks. 20 times 100 is $2,000. The thing went up 6,000% in one day because it was priced so cheaply, because there was so little time value and absolutely no inherent value, until the inherent value went from 0 fractions of a penny to hundreds of percentage points, thousands of percentage points, as it added $20 to a base of like 2 pennies to buy the option. That trade made a lot of people very wealthy very quickly. Why? Because options are leveraged investment vehicles. And while my trade on GE, the earnings report was slop, if I made 10 more of those trades and one of them was in Texas Instruments, that would have more than made up for each of those individual losses. So if you can just get one huge winner, it can pay for and profit above, 10 losers. So that's the real goal here. At least that's one strategy, is to just aim for home run trades. And, try to make, singles and doubles along the way for sure. Definitely try to get solid, high quality, great percent chance setups. But remember that just one really, really, really good trade, when you're just one trade away from thousands of percent gains, you put $1,000 in there, that's 2,000, put another couple of zeros on it, that's $200,000. Those of you guys who don't know the perspective I'm coming out with this, when I was trading cryptocurrency, and still trade cryptocurrencies obviously, but during the bull run of 2017, I was in these positions, and I pretty much turned about $400 into like 40 grand, and I had a lot of positions where they basically, it was like $100,000. Now obviously I lost $100,000 as well during the crash because I didn't know what I was doing. I didn't have the right setups, I didn't have the right education. But like, you guys got to understand, you can seriously turn a very small, finite amount of money into a lot of money really quickly with the power of capital markets. When I was turning, a couple grand into $100,000, I did that entirely. Cryptocurrencies, obviously, there weren't options, right? So that was just with normal investments. So I want you guys to understand that with the power of options, what you have in the stock market is like a 2-punch combo. And as soon as you master the fundamentals and you understand the financial education that you need to have that overarching success, that development and that growth and whatever it is that you're doing, you're going to have freaking massive growth. I want to give you belief here, and I want you to inspire you to look for patterns like this. So with Texas Instruments, they do really well on Q3 usually. Look for patterns like that. Another great example, I made a trade 2 years ago in Regal and AMC, and Regal and AMC are both really cool companies because for some reason or another, a vast majority of the time, they kind of do the same thing. They're very, correlated stocks. And what was interesting is I looked at them over the years, and basically every time it was December, they went up a lot because, a lot of new movies in December, a lot of increased public perception of movies in December, people going out, families, social spending, people going on dates, whatever. There was a lot of growth in December. So I bought these guys in December, and with Regal specifically, within 2 months, the company got bought out. I went from 15 bucks a share to $21 at the buyout price. That's a pretty nice string gain. And I want you guys to understand, I didn't know about options at the time, and I didn't understand this concept that you could have a very finite period of time multiplier results. So I made, $6 a share. That's really, really, really good. I want you guys to think about this from an options perspective and understand that if it costs $1 to control this stock, You make $6 over the course of a couple of months because you have a solid understanding of the technicals. A lot of this trade basis was technicals. It was based on very low stochastics, very low, the moving averages were like way bouncing off the moving averages. It's been a while since I made this trade, but it was definitely based a lot on stochastics, a lot on MACD, a lot on moving averages, and we'll get into those technical indicators and really break down how to trade options with them very, very soon. But the fundamental basis of this trade was based on technicals, and then of course it was this extra part of it with December. Same thing with that trade on Texas Instruments. The fundamental basis of the trade is not just Q3 earnings, but the fundamental basis is actually the technicals, right? And then those fundamentals support it, and the earnings report is the catalyst for the movement. Same thing here. The fundamentals are, it's all based on the technicals, right? And so that's why I teach technicals. That's the most important part. And you make this trade right here. You put down $1 to control the stock. You make $6. That's a 6x return, so $6 per dollar that you risk. That's a really, really, really good thing to do. You do that 10 times, you're gonna crush it, dude. Because I mean, it's just amazing what options let you do, because they let you get into these positions that ordinarily maybe you wouldn't be able to afford to do. And I don't say that lightly because it's dangerous. You've got to remember, you can lose all your money. I traded for 2, 3, 4 years before I started investing in options because I had to understand the fundamentals. Now, what I'm giving you in 9 to noon is pretty much everything I know. So this should really, really, really skyrocket your success and shortcut years and years and years of learning. But please, please, please make your first couple of normal trades before you get into options, because remember, you can't lose everything here. And you want to understand, just make your first couple of stock trades, start to get comfortable with technicals, start to get comfortable with order entry and order setup, because we're going to talk in just a little bit about how to actually put in your orders and figure stuff out and make it work. And that's a little bit more complex than just buying and selling a stock. And I'm not saying you have to wait 3 years like I did, because you do have very, very powerful tools at your disposal in this 9 to noon members area and these courses and the book. I mean, it's awesome. But you definitely want to make sure that you understand what you're doing. And that's why I have this training for you. And that's why the next module, we're going to look really more into leverage and then how you can absolutely crush it trading options today. So awesome stuff, guys. Hope you got a ton of value from this training. Go out there, crush it. Have an amazing, amazing day. And I will see you in the next module. Thank you so much. Bye.